Level 1. The acquisition machine. How you buy. You are a portfolio manager at BlackRock. Not the CEO, not the headline. You're 3 levels down. You run a single-family residential acquisition fund. Your mandate is simple. Deploy $840 million in the next 18 months. Not might deploy, will deploy. Because the capital has already been raised. The investors have already wired the money. Pension funds, sovereign wealth funds, university endowments. They don't care about one house. They care about yield. Predictable, recurring, inflation-adjusted yield. And nothing delivers that better than rent. Your team doesn't drive around looking at houses. You have an algorithm. It scrapes MLS listings in real time, filters by price range, neighborhood demographics, school district ratings, proximity to employment hubs, crime data, historical rent comps. A house hits the market in Charlotte, North Carolina. 3-bed, 2-bath, listed at $340,000. Your system flags it in 11 minutes. By the time a local family schedules a showing for Saturday morning, your acquisition team has already pulled the property tax history, reviewed the last 3 sales comps within 0.4 miles, modeled the expected rental yield at $2,100 per month, run a 10-year cash flow projection, submitted an all-cash offer at $362,000, $22,000 over asking. No inspection contingency, no financing contingency. Close in 14 days. The family that wanted to raise their kids there, they offered $345,000 with an FHA loan and a 45-day close. You win. Not because your offer was better for the seller's soul, because it was cleaner, faster, and removed every friction point that makes transactions fall apart. You do this 340 times this quarter, not in one city, across 22 metro areas: Phoenix, Atlanta, Tampa, Charlotte, Nashville, Raleigh, Indianapolis, Las Vegas. You don't care about the neighborhood. You care about the rent-to-price ratio. If a house rents for $2,100 per month and costs $350,000 to acquire, your gross yield is 7.2% annually. After property management fees, maintenance, taxes, insurance, your net yield lands around 4.8%. Your investors are fine with 4.8% because it's stable, it's recurring, and it's backed by an asset that people need, not want, need to live in. Stocks are volatile. Bonds are boring. Real estate? Real estate is a rent check every single month from someone who has no choice but to pay it. The family that lost the bidding war? They're about to become your tenant. Level 2. The rent optimization model. How you extract. You don't just buy homes, you operate them. This is where the real money gets made. You are now the director of revenue management for a single-family rental platform. You oversee 16,000 homes across the Sun Belt. Your job is not to keep rents affordable. Your job is to maximize rent growth within the bounds of what the market can absorb without triggering mass vacancy. You use a software platform called RealPage or Yardi. It aggregates rent data from competitors in real time. It tracks move-out rates, lease renewal percentages, days to fill a vacancy, and it tells you, down to the specific property, exactly how much you can raise rent without losing the tenant. Here's how it works. A tenant in your Tampa property is paying $1,850 per month. Lease is up for renewal. The software pulls comps. Similar 3-bed homes in a 2-mile radius are renting for $2,050 to $2,150. It models the tenant's behavior. No late payments in 18 months, stable income, 2 kids in the local school district, probability they move if you raise rent to $2,025, 18%. Probability they stay, 82%. You send the renewal offer. $2,025 per month, 9.5% increase. The tenant calls, says it's too much, asks if there's flexibility. Your property manager, who works for you, not them, says, "Unfortunately, this is in line with market rates, but we'd love to keep you. Let me see what I can do." 3 days later, "Good news, we can hold it at $1,995. The tenant feels like they won. You still raised rent $145 per month. Across 16,000 properties, Raising rent an average of $120 per month adds $23 million in annual revenue. You didn't build anything. You didn't improve anything. You just owned the house they need to live in. And here's the part that makes this a system, not a fluke. Your competitors, Invitation Homes, American Homes for Rent, Progress Residential, are using the same software. You're not setting prices independently. You're all algorithmically coordinating to raise rents in sync. No one calls it collusion. It's just market rate pricing. But when 5 corporations control 40% of the rental stock in a metro area, and they're all plugged into the same pricing engine, the market isn't setting the rent. You are. Level 3. The financial engineering. How you scale. You are now a structured finance analyst at a major bank. Your client? Invitation Homes. They own 83,000 single-family rental properties, and they just came to you with a request. We need $4 billion. Not to buy more houses. They already did that. They need to refinance the houses they bought and extract the equity. Here's how the magic works. Invitation Homes bought a house in 2021 for $280,000. Today, that house is worth $395,000. They didn't sell it, but they can borrow against the appreciation. You bundle 12,000 of these homes into a single security, a single-family rental bond. Investors buy the bond. Invitation Homes gets $4 billion in cash. And what do they do with that $4 billion? They buy 11,000 more houses. They didn't use new money. They used your home's appreciation to buy the next house you were going to bid on. This is how Wall Street turns housing into an infinite loop. And the investors who bought that bond? Pension funds, insurance companies, sovereign wealth funds. They're not villains. They're just looking for yield. But the structure creates a system where corporations can outbid individuals infinitely. Every house they buy creates capital to buy the next house. Rental income funds the debt. Appreciation funds expansion. And the individual buyer never catches up. You're not competing with a family. You're competing with a self-reinforcing financial machine that turns your rent into their next acquisition. Level 4, the Endgame. Why they want you renting forever. You are now in the boardroom, not BlackRock's public boardroom, the private one, the one where the 10-year strategy gets written. And the slide on the screen says this: home ownership rate target, sub 60% by 2035. Someone asks, why would we want that? The CFO answers, because renters are recurring revenue. Homeowners are one-time transactions. If we can shift 8% of the U.S. housing market from ownership to institutional rental, we're not managing properties. We're managing a subscription model. They don't say this in earnings calls, but the strategy is written in the acquisitions. Every home BlackRock, Invitation Homes, or Pretium Partners buys is one less home a family can own. And every family that can't own becomes a renter. And every renter pays rent to the same institutions that outbid them in the first place. This isn't capitalism. This is capital consolidation. And the end game isn't homeownership for all. It's renting for most, owned by few. In 1984, corporations owned 2% of single-family homes. In 2024, they own 28% in some markets. If that trajectory continues, by 2040, corporate ownership could exceed 40% in Sunbelt metros. At that point, homeownership isn't hard. It's structurally unavailable. Right now, someone is sitting in an apartment they can't afford to leave. They're saving $1,200 a month. They've been saving for 3 years. They have $43,000, enough for a down payment. They found a house, $360,000, perfect size, good schools, 20 minutes from work. They submit an offer, $365,000, pre-approved, inspection contingency, 30-day close. 3 hours later, the listing agent calls. We received a stronger offer, all cash, no contingencies, closed in 2 weeks. The couple asks, can we match it? The agent says, it's a corporate buyer. You can't compete. They don't know the buyer's name, but you do. It's a subsidiary of a private equity fund backed by a sovereign wealth endowment that will never live in that house. never step foot in that house, and will rent it back to someone exactly like that couple for $2,400 per month. This isn't a housing shortage. This is a housing takeover, and it's not coming. It already happened. You just spent 12 minutes learning what the real estate industry will never say in a listing description. If you made it here, you're not casual, you're awake. Subscribe. I don't make content for everyone. I make it for the people who refuse to accept the narrative. Drop a comment. One word. Are you priced out, renting, or still fighting? I'll see you in the next room.